Hello again, Paul Spence with the UAB Collect Tutor Lab again. Today we're going to go over Chapter 2, go over some of the concepts and things covered in it. I'm going to do that by walking through a problem with you, step by step. So if you want to open up your books to page 81, we're going to do problem 2.9. I'll give you all a minute to do that, catch up. And then, as you can see, I've all got it figured out behind me. While y'all are doing that, I'm going to tell you about the accounting equations some more and what we've got up here because it's a little more complex than in the other one. As you can see, assets same, but over here under equity we've got this additional part. And this is what equity is made up of. So your equity is your common stock minus your dividends plus your revenue minus your expense. Now this is obviously for a publicly traded company or someone that sells stock in their company. If it's a privately owned company, then your common stock is going to be owner's equity or owner's capital, and your dividends is going to be whatever they decide to name it for what they're paying out to the owners when they take money out. But that's what that is. You'll also notice that under these, the T accounts look differently. Now we spoke about T accounts before. I know I didn't realize y'all didn't get into it until Chapter 2, but T accounts, debits are on the left, credits on the right. DR for debits, CR for credits. And as I said before, assets, positive asset, debit, liabilities, positive liability, credit, and then equity was the same way. You'll notice that it's different for dividends and expense. That's actually just for these two particular accounts we put that. The way to think of it is when you have a dividend being paid out, an increase to your dividend here, it's actually decreasing your equity. And then the same thing for expenses. If you have an increase in your expenses, you have a decrease in your equity. So that's why they're on this side. And those symbols are up there. So if you can just remember that, it takes some time, but trust me, after you've done a few of these problems all the way through, you'll get it like that. All right. So I'm assuming everyone's to the page and ready to go. So let's see what the problem is. We're going to prepare general journal entries to record the transaction below for Spade Company by using the following accounts. I'll let y'all read those accounts off and everything. They're already up on the board, all of them. I know it may be hard to read, but I'll tell you what they are. We use a lot of shorthand in accounting, so whatever you can recognize works. All right, let's just get right into it then. After recording the transactions, post them to T accounts, which we're going to do up here. And then we'll determine the ending balance for each T account, which is up here as well. All right, first transaction. Casey Spade, owner, invested $100,750 of cash in the company in exchange for common stock. All right, so an increase in cash, asset account. So we're going to debit the cash over here for $100,750. I know that's kind of hard to see, but there it is right there. There's an A by it, so we can mark that. And then the corresponding account is here under common stock. Notice it's a credit increase in common stock, $100,750. Now this doesn't represent an increase in Casey's stock. This represents an increase in the amount of stock the company issued. That's that business entity. We keep the recording separate assumption we have to go with there. So there's that transaction. This is actually being posted to the T accounts here. We've got it up that way. The journal entry will look like this. You'll have cash, and then the 100,750, and then indented to the side will be the name of the other account, the credit account, common stock, and then indented to the side here. Here's that. So if everyone can see that, I know it's a little bit messy, but this is the way a journal entry looks. The debit will always go on top, and then below it, and indented to the side, both parts, the credit. And that's how you would make a journal entry. Usually you have the date over here so you can track when the journal entries were made, and you just list those below each other. So that's how you'd enter them. You can do that for all of these. Just whatever account you're debiting, you'll put up top. Whatever account you're crediting, below and indented. All right. So I'm going to move that. So if I have to explain anything else. All right. Next transaction. The company purchased office supplies for $1,250 in cash. All right. So incoming, we have office supplies. Office supplies are an asset. They're something we own. So we're going to office supplies here. Debit it, increase. for $1,250. And then going out is cash. We're giving them cash for it, so we're going to credit the cash account for $1,250. Same thing here. You have office supplies up top with the amount, and then below it and indented would be cash, and then the amount for that journal entry. The company purchased $10,050 of office equipment on credit. All right. So over here, office equipment debited. That's what we got coming in for $10,050. All right. And then over here under the liability section, we have an accounts payable that will credit for $10,050. We purchased it on credit. So we've gotten the equipment, but we haven't paid it yet. We have to recognize that we owe that money. We put it into credit, which increases our liabilities here. That's that portion. Then the company received $15,500 cash as fees for service provided to a customer. All right. Increase in cash, $15,500. And then revenue. We were paid for a service we performed, so we'll increase our revenue by the same amount, credit to it. Yep. Followed by that is the company paid $10,050 in cash to settle the payable for the office equipment purchased in transaction C. So we'll go back to C where we purchased this office equipment and we had our payable. Well, now we're going to erase this payable. We're buying it, paying this off, and we'll take out the cash for it. Now, some of you may have noticed that at no point in here have I done anything with the expenses for this equipment. And that's because we didn't actually have an expense. This is an asset swap transaction. We gave up one asset, cash, in exchange for another asset, which is the office equipment. That's called an asset exchange. We did it in a payables form, which is most common because most people don't pay full cash for things. They put it on liabilities. But that's what that is. It's an asset exchange. So there's no expense related to that one. Next, the company billed a customer $2,700 as fees for services provided. Right. So over here, accounts receivable. We're going to mark it as money we're owed in our assets because we're supposed to be getting that money, but it's not cash or anything. Okay. And then because we're owed the money in this time, we're going to go ahead and recognize it as revenue right here. Yes. Sorry. As revenue. All right. That's where that revenue recognition principle comes in. We haven't received the money yet, but we're owed it. We've done what we're supposed to. They're required to pay us technically. We're going to go ahead and recognize it as income, as revenue right there, even though it's only a receivable. We haven't actually received the cash yet. Next, the company paid $1,225 cash for monthly rent. All right. Cash out, credit to cash, $1,225. Expenses. Again, it's a debit to expenses for $1,225. Like I said, expenses go up, equity goes down. It also is to keep things balanced. It's all about balance. So if you have a transaction on one side of the T account, you have to have one on the other side of the T account. And I'll explain that some more when we get to the trial balances and balance sheet over there on the other side. The company collected $1,125 cash as partial payment for the accounts receivable created in transaction F. All right, so over here, now we'll get the cash. So we take $1,125 out, we credit accounts receivable, and we debit cash, $1,125. This is another example of an asset swap. This is an asset that we were owed that we're finally getting. We're just moving it from receivables to cash to recognize that it went from money we were owed to money we have. There, so we've already recognized the revenue earlier. And then finally, the company paid $10,000 cash in dividends to Spade, the sole shareholder. All right. $10,000 credit, cash going out. And then to dividends, $10,000 debit, representing a decrease in our equity because we have money leaving the company and going to the owner now. All right, so that is all your T accounts right there and how they are formed. And you notice we totaled them out at the end. We went through and added up all this side, added up all this side, and then took whichever side was larger and subtracted the other side from it. So if this side was the larger side, we subtracted all these. This is our total. Right? And I'm going to show you why we do that over here with trial balances. So just bear with me. All right. So hopefully everyone can see okay. All right, so this is a trial balance. As after we've totaled them all out, we mark each account. We put a big T account up, and then we put what the total was. So the total in our cash account, $94,850. Office equipment, $10,050. Notice these are debit totals. These were totaled out on the debit side. Liability had credit total of nothing. We had one liability, but we paid it off, so it's down to zero. Common stock has a credit total. Service revenue has a credit total. Rent expense and dividends have debit totals. All right. So after we get the totals put on each side, we'll go through the same thing we did before and total each side up. But instead of subtracting them, we want to compare them and make sure they match. And that's what a trial balance is. We're making sure that all our T accounts balance out. We have the same number of credits and debits and the same quantity or value in each set of credits and debits. This is a quick and dirty way to make sure that you didn't accidentally hit the wrong number when you were putting them in or write the wrong thing down. Is this way. It will not tell you that it's absolutely perfect. Don't think that. If you accidentally put 1580 when it's supposed to be 1575 here, and you do the same thing for the other side, or in this case over in one of these transactions we did, you put the wrong number in on both sides, this will still balance out, but that's wrong. It's still wrong. So this is just to let you know that you didn't have a typo, not necessarily that there wasn't an incorrect entry or even a missing entry. So that's the trial balance. You will do this at the end of every period. So usually it's the months, quarters, years. You'll do a quick trial balance, make sure all this balances out. You'll double check, total all your accounts out, and then you'll start preparing your statements, which we're going to get into on this side. All right. The first statement you prepare is an income statement. Okay. For an income statement, we take our service revenue minus our expenses, get our net income. Simple. Everyone can do that. Take service revenue total from over in the trial balances, minus out your expenses from the trial balances, get you your net income, $16,975. You need to do this one first to get this number because it goes into the next statement. These flow into each other, these statements. So there is an order you're going to want to do them in, starting with the income statement. After the income statement, you have your statement of retained earnings. Retained earnings is an actual account you'll have on your sheet, your balance sheet, your accounting records. At the end of each period, after you've done all this and come up with your income statement, you'll take all of your service revenues and expenses and pull them into your retained earnings account. Right? And so our retained earnings account had a beginning value of zero. There was nothing in it. We're going to assume it was the first month. They just opened the company. They'd never done business before. So you'll start with your beginning account, beginning value in the account. And you're going to add your net income, that $16,975 number. Right? And we're going to subtract out dividends because that's not money the company's keeping. We're not retaining those earnings. We're giving them back to the owner, the shareholder in this case. So we're going to subtract them out of our net income, and that'll give us what our remaining retained earnings is. This is at the end of the month. This is all the money we kept. We retained $6,975. So that's our retained earnings. Retained earnings statement looks like this. Cleaner, obviously, but that's basically it. And then you'll go to your balance sheet. Balance sheet flows from assets to liabilities to equity. And the balance sheet is basically the accounting equation and in a very long, extended form. That's all it is. You'll start with each asset account and what its total is from the trial balance sheet, listing them out. You'll add them all together and get what your total assets are. So total assets equals $107,725. Then you'll move to your liabilities, and you'll add them all up. We only had one liability account. It was zeroed out, so total liabilities, zero. Next, you'll do equity account. You'll take all your equity, your common stock, and your retained earnings are typically the only ones in there. You'll add them up, you'll total them up. Then you take what your liability is and what your equity is, and you'll add them together to get your total liabilities and equity, $107,725. These numbers want to balance. That's why it's called a balance sheet. Right? Assets equal liabilities plus equity. Right? That's the quick and dirty balance sheet, income statement, retained earnings, trial balance. All right? Again, if you have any questions or want additional help with anything, contact Collat Tutor Lab at uab.edu or Collat Tutor Lab on Skype, and they'll be happy to help. Thank you.